All right, let's get right into it. We are tracking a massive capital rotation happening in real time, and today we're going to lay out the entire institutional thesis for you. Now, just so we're clear, this isn't financial advice. It's a data-driven analysis for educational purposes. Let's go.
Hit the like button, subscribe to the channel, and comment your top ticker right now. Retail thinks $1 trillion in credit card debt is a personal failure, but Wall Street knows it's an engineered mathematical trap. Today, we expose the 1978 banking loophole that ruined the middle class and show you exactly how institutions are shorting the consumer to hoard the physical AI grid.
So how did we get here? Look, this wasn't some kind of accident. This was a calculated systemic process. Let's break down the mechanics of the trap.
It all starts with this number, over $1 trillion in credit card debt. That's an all-time high. And for most people, this isn't about buying luxuries. It's become a plastic safety net just to cover basic living expenses. Now, this is where the story gets really interesting. Look at this divergence. Over the last 10 years, real wages, they've gone absolutely nowhere, flat. But the cost of carrying debt? The average credit card APR has almost doubled to a ridiculous 22.8%. That gap right there, that 14.3% APR margin, that's pure record-breaking profit for the banks.
And here's the origin point. This is how they did it. Before 1978, states had usury laws to protect people from insane interest rates. But then came a Supreme Court case, Marquette National Bank versus First of Omaha, which blew a massive loophole in the system. It let banks export the interest rates from their home state to literally anyone, anywhere. So what did they do? Of course, they all moved their card operations to states with zero interest rate caps, and just like that, high-interest debt became the national standard.
Okay, so that's the history. Now let's flash forward to today and see how this becomes a massive institutional trade. We've got to follow the money, and to do that, you have to know how to read the dark pool prints.
So you need to look very closely at the screen right now. The institutional footprints are all over the tape. Once you see it in the data, the entire thesis just locks into place.
So on the left, you've got Capital One, ticker COF, our proxy for consumer credit. We're seeing huge, sustained dark pool volume with over 70% of those prints happening below the volume-weighted average price. That's not just selling, my friends. That is textbook institutional distribution. They are getting out. Then on the right, look at Vistra Corp, ticker VST, a key player in the physical AI power grid. It's the perfect mirror image. Massive volume, but with over 70% of the prints above VWAP. That's classic institutional accumulation. They're buying every share they can. So let's translate this. In plain English, it means Wall Street's algorithms see that the consumer is completely tapped out. So they're using this down escalator trap to harvest retail's labor, and then they're taking that profit and buying up physical utility monopolies. Because guess what? Data centers don't default on their credit cards. This entire strategy has a name. It's a specific quantitative arbitrage play. And if you can understand it, you can start seeing the market through a true institutional lens. We call it the down escalator arbitrage. Simply put, you short the assets that are chained to the dying consumer, the credit card companies, while you simultaneously rotate all that capital into sectors that are totally insulated from them, sectors funded by big enterprise spending. Right now, that's the physical AI layer. Here's how the playbook works. It's a three-step process. 1. The banks harvest billions in profits from these insane APRs. 2. Their quants see the default wave coming, so they start systematically shorting the consumer credit stocks. And 3. They rotate all that capital into what they see as the ultimate safe haven asset, the physical grid that powers AI, which is all funded by rock-solid enterprise capex.
Before we map out the bear and black swan scenarios for this trade, hit subscribe so you don't miss our weekly dark pool audits.
Okay, so any professional trade requires mapping out all the potential outcomes. Let's stress test this thesis: the bull case, the bear case, and the black swan that could change everything. So the bull case, the primary thesis, is simple. The data plays out, consumer defaults spike hard, and the market is forced to reprice the risk. This sends consumer credit stocks like Capital One into a nosedive, while all that capital floods into AI infrastructure plays like Vistra, sending them absolutely parabolic. Now, what's the biggest risk here? The bear case is a Fed intervention. If the system gets too stressed and the Fed steps in with emergency rate cuts, it could throw a lifeline to the consumer. That would probably trigger a massive market melt-up and completely invalidate the short side of this arbitrage. And then there's the black swan, the real tail risk.
Imagine a major successful hack on a credit bureau, like Equifax. If that core data gets compromised, global lending could literally freeze solid overnight. In that kind of chaos, all conventional bets are off. The system itself would be at risk.
So, with these scenarios in mind, how do you defend your capital? We need a strict quantitative protocol, both for the markets and for your own personal balance sheet. For the market, these rules are non-negotiable. 1, you must use OTO brackets to define your risk and your target before you even enter a trade. 2, you deploy dynamic trailing stops based on a 2.5x average true range to protect your baseline. And 3, you absolutely do not, under any circumstances, trade an asset below its 200-day moving average without a direct hedge, period. And for your own finances, the defense protocol is just as vital. First, you have to attack the high APRs. Use 0% balance transfers to stop the compounding engine working against you. Second, deleverage systematically. Use the avalanche method. Hit the highest interest rate debt first and hardest. And finally, reject the gamification. Those rewards points, they are not your friend. They're a psychological trick to get you to spend more.
So when you boil it all down, this whole analysis highlights the central conflict in the market right now. The overleveraged consumer on one side and the institution's positioning for what comes next on the other. And that leaves us with just one final provocative question you have to ask yourself. Are you positioned with the consumer or with the institutions that are betting against them? If you want to trade with a quantitative edge, hit the like button, subscribe to the channel, and drop a comment below with your specific thoughts on the debt trap and the tickers we mentioned, COF and VST.